Hello, everyone. I'm Matt Clark, research analyst with Money Markets, here with your weekly Bull in the Bear podcast. Now, if you haven't already, I do want to encourage you to subscribe to our YouTube channel. You're going to find a lot of great features here, including videos from Chief Investment Strategist Adam O'Dell, Green Zone Fortunes co-editor Charles Sizemore, and myself. We do things new every single week. We've also created a new membership program here on our channel that gives you exclusive cannabis market information, as well as stocks, interviews, news, so much more. And I want to make sure you're checking out our website as well, moneymarkets.com. Check it out every day. We have safe, sound, smart, simple, profitable investment information for your portfolio. Our team works very hard every day to provide the best information to bolster your gains. Now, when you check out the website, also do sign up for our free daily e-letter. You'll get all that safe, sound, smart, simple, profitable information sent to your email each and every day for free. Now, on with today's podcast today, I'm going to talk about why the market may be due for a correction. And I'm also going to go over our recent YouTube poll. Now, first off, I'll start with the market. It's really been a great run for the market of late. We've seen one of the longest uninterrupted rallies in the U.S. equity market in history, and that's thanks to an apparent retreat of the COVID-19 pandemic that we've experienced previously and the Federal Reserve easing its monetary policy. Investors have been chomping at the bit to get into the market, but all that could be changing, and the stock market could be due for a serious market correction. Now, there's been a resurgence in COVID-19 infections across the country because of this new Delta variant that we've talked about, which is a variation of the original strain. And it is causing some states, including my home state here in Florida, to see record numbers of infections. Plus, we've seen inflation jump to levels that even above projections as the cost of goods and services only seem to get higher. Now, I've told you before that none of us really have a crystal ball to see into the future. There's no way I can tell you if or when a market correction is going to happen, and no one can. Anyone who tells you that is probably not being straightforward with you. However, we can look at data, which is what I love to do, and project how things might possibly shake out. First, history does tell us that the last time the S&P 500 experienced what's called a 5% drawdown, this is basically a 5% drop in index value, was in late October of 2020. So it didn't happen all that long ago. And since that drawdown in 2020, all three major U.S. indices have jumped around 35%. That is a massive jump. And to be exact, the S&P 500 has risen 35.2% since November of 2020. The NASDAQ Composite Index has jumped 35.2% as well. The Dow Jones Industrial Average has moved 32.5% to the positive in the same time. To put all that into context, it's been more than 180 days since that 2020 drawdown of the S&P 500. So we've gone basically half a year without any kind of significant drawdown in the S&P 500. Now, according to Goldman Sachs research, they put out a research memo a week or so ago. This is one of the 15 longest stretches in history that the market has not seen a 5% correction. Now, if you are thinking logically, you realize that it happens eventually. It just hasn't happened yet. The longest stretch without a correction was 404 days, and that ended in February of 2018. But what's even more telling here is the average time between 5% corrections since 1950, 97 days. So basically, we've averaged 97 days of strong market run, or at least flat market run, before we see a 5% or more drop in the broader market. And that means right now that we've actually doubled the average time between market drops. And some of the reasons why we haven't seen a decline already is simple. There's a couple. One, there's an increase in household net worth. Net worth increased 24% from the first quarter of 2020 to the first quarter of 2021. Then there's also higher personal savings. The personal savings rate was 12.4% in May of 2021. The average from 2019 to from 2000 to 2019, 6.1%. So we've doubled the savings rate in May of 2021. And also the Federal Reserve's policy to keep interest rates at near zero and continue buying about $120 billion a month in bonds. That's a month. What it's done is it's infused cash into the market, and it's made investors kind of very excited about buying up new equity positions. But now we see a bit of a change. We've seen a surge in COVID-19 infections, which I'm going to get to a little bit later, and inflation has risen higher than expected, than we normally would expect to see over a period of a month. And that's led to a rising demand in government bonds, typically considered a safe haven against a market downturn. So that's a telltale point. Investors are scrambling and getting into bonds a little bit more now, maybe because they're worried about a possible correction on the horizon. If you look at the 10-year Treasury inflation index security bond, this is what's otherwise known as the real yield. It's dropped to minus 1.17. That's a record low. The negative yield means that investments in the Treasury market are actually losing money, and it's been negative since the height of the COVID-19 pandemic in March of 2020. The benchmark 10-year Treasury yield is still more than 40 basis points below its March 2021 high. These low yields have been good for the stock market, but when the Fed decides to end this round of monetary policy, it's all going to change. The bottom line here is that the market is ripe for a correction. We don't know when it'll happen. We don't know how fast it'll happen, but it is going to happen. Yields are pushing lower, suggesting the boom in the market isn't ending just yet, but it's going to. Your best bet now, in terms of how do you kind of prepare for this, is to look at strategic hedges, gold, bonds, even cash, having that in your portfolio to guard against this inevitable correction that's on the horizon. Can't really say that there's one better than the other. We've talked about gold, we've talked about crypto, we've talked about bonds, we've talked about cash, we've talked about all that. It's kind of a personal preference in terms of what your portfolio is. I would probably look more towards gold as a hedge than bonds or cash, but I would also have a little bit of cash in my portfolio as well. Now, that's my take on that and what I think about the upcoming correction. Like I said, it's going to happen. It's just a question of when. Now, I want to look at the results from our latest poll on YouTube, which kind of ties into this a little bit. Last week, we asked if you were ready to return to the office for work, as it comes on the heels of Google actually announcing that they were delaying bringing workers back as COVID-19 cases started to surge across the country. More than half of you said that you were not ready to return to work, and only 13% said that you were. The rest of you said you were already back at the office anyway. Kristen commented, bad timing with the Delta variant raging. We've done work from home for nearly 18 months, so why not continue keeping people safe? That's a valid point. Nicole commented, I found I'm much more productive at home, and I typically work more since I don't have to worry about the commute to and from. Also valid, and two things I can definitely agree with. P commented, work from home allows people who are disabled to have an opportunity to get back into the job market. It allows us to be in a much safer environment with the new COVID variant raging. Also, very, very positive, very good. I agree with all three of these things. I think that working from home definitely has benefits. Studies have shown that people are actually more productive because of maybe the comfort of being at home, less stress about driving to and from work, things like that. It's just kind of a personal preference. But most people, myself included, I actually prefer working from home. I find myself to be way more productive. But I do want to thank everyone who voted and commented on our poll. We're going to have one up every week on our YouTube channel, so make sure you check it out. To kind of circle back on COVID-19, according to the Centers for Disease Control and Prevention, the U.S. had seen a sharp uptick in the number of COVID cases reported since late July. On July 30th, the U.S. had more than 105,000 new cases reported. That's the highest number daily reported since February 6th. And these are new cases. So 105,000 new cases, the highest number since February 6th. The 7-day moving average for daily cases has swung to near 85,000. That's the highest since February 16th. So we are definitely seeing a trend that the number of COVID infections, however, are ticking up. Now, I do want to make sure you're checking out our YouTube channel. Head over to youtube.com. If you're listening to this as a traditional podcast, search Money and Markets. We've got the green bull and bear logo. Make sure you subscribe, click that subscribe button, and then mash that notification bell and get notified every time we release a new video. We've got other new videos that are coming out all the time. Ask Adam anything. I get to sit down with Chief Investment Strategist Adam O'Dell and talk about just about anything either you or I want. It's great. It's fun. I like to throw him off. Sometimes it works. Sometimes he doesn't. He's actually really smart. So I don't always get the better of him, but I try really hard. Charles Sizemore also has a new video series, Investing with Charles. He and I sit down and we talk about broader economic topics and really kind of make them simple to where anyone can understand, and also give you some actionable advice on what you can do based on some of these trends we see in the economy. All that is on our YouTube channel. Also, I host the Bull and the Bear podcast, as you're listening to now, and our marijuana market update, which is every week where I give you insights into the cannabis market. All that is on our YouTube channel. You can check all that out right now. We've launched a new membership community on YouTube. It gives you exclusive content related specifically to the cannabis market. It includes interviews, company breakdowns, advanced insight into our cannabis watch list, and so much more. So do check that out. If you're on YouTube, maybe you want to listen to this as a podcast, you can do so by checking out your favorite podcast syndicator like Apple Podcasts, Google Podcasts, Amazon, Spotify, iHeartRadio. There's a wealth of them out there. We're on a bunch. Check it out, subscribe, make sure you get notified every time we release a new podcast. Leave us a review or comment either on YouTube or on your favorite podcast syndicator. We'd love to see your feedback. If you do have a comment or a question or a particular stock or sector you'd like any one of us to look at, you can email us at feedback@moneyandmarkets.com. Very simple. We'll flash that down there. feedback@moneymarkets.com. We love to do that as well. Also, if you send us a question, or maybe even get creative and send us a video of a question or a testimonial or something like that, and we use it, we are going to send you some cool Money and Markets swag. So make sure you do that. The email address is feedback@moneyandmarkets.com. Also head over to the website, moneyandmarkets.com. Each and every day, sign up for our free daily e-letter. We give you safe, sound, smart, simple, profitable investment information, all for you and for your portfolio. Until next time, this is Money Markets research analyst and host of the Bull and the Bear podcast, Matt Clark, wishing you all safe trading.